Good morning. Welcome to an episode of the Mizuho Week Ahead. I am Boon Heng, market economist at Mizuho Bank. This week's theme is opening up. Last week, the dollar continued to rise higher as early hopes of a toned-down plan for Trump tariffs were quickly dashed, and a rise in US job openings backed up Fed officials and FOMC minutes, which reiterated the case for cautious rate cuts. US equities could not hold on to the higher opening at the start of last week as euphoria on tech faded and prospects of tighter monetary policy waned. USD yield curve continued to steepen as longline yields rise on fiscal worries ahead of Trump's inauguration on 20th of January. Furthermore, last Friday, the US NFP print at 256K exceeded expectations, and the Uni of Michigan survey showed higher inflation expectations, and this sent front-end yields soaring. The US was not alone on their fiscal woes, as fears of soaring fiscal deficits in the UK saw a surge in gilt yields and the pound sold off. This was amid signs of softer price pressures and employment. Meanwhile, weak consumer spending in Japan continued to restrain bets for a January BOJ hike, though it remains very much on the table. EM Asia will continue to worry about China's recovery as the latest CPI print at 0.1% year-on-year did little to alleviate deflation concerns. Across the region, the BSP saw room for rate cuts, even as inflation accelerated to 2.9% in December. Consequently, the peso underperformed. The Aussie also headed lower, as lower than expected retail sales conspired with lower trim mean inflation to pave the way for the RBA to cut rates. Vietnam's economy outperformed as Q4 GDP growth of 7.6% resulted in overall 2024 growth of 7.1% to exceed the official target as exports demand remained robust to bolster the manufacturing sector alongside strong activity in the services sector. Looking ahead, the Fed and markets will need to contend with interpreting December CPI print this week. Markets will also get a further assessment of economic conditions in China. In Korea, the BOK will have to contemplate the need to provide further preemptive support to growth amid the political drama. Given that inflation remains well contained, housing price momentum in Seoul has slowed, the macroeconomic conditions are appropriate for further normalization of monetary policy. All in, we expect a 25 basis point cut and for Governor Lee to signal cautious calibration and the need for an assessment period after 3 cuts. Bank Indonesia, though, will stand pat as their hands are tied. With growth still holding up, rupiah weakness takes precedence, and the recently watered down VAT implemented engenders more fiscal worries. In Malaysia, amid base effects, growth is expected to moderate to around 4.5% for Q4 as weather woes hit the agricultural and construction sector to offset services sector resilience. For 2024, growth is likely to reach 5% in Malaysia, which is around the midpoint of the official range. All in, for the week, we ought to remain open to the increasingly varied outcomes and tail risks confronting markets as we prepare for Trump 2.0. For more information on the events this week, please refer to our Week Ahead publication or contact your respective sales desk and RMs. And for regular notification on our market views, please subscribe to our channel and hit the notification button. Thank you.